1.1 Investment and Saving Principles. There are certain time-honored principles that apply to investing and saving. It is essential to understand these basics, which are the foundation of all investing and saving, before focusing on segregated funds and annuities in particular. The concept of investing. Investing occurs when money is used for the goal of making more money. A business invests money in new equipment, for instance, that will help it make more products faster or cheaper. The business profits from its investment. The goal of individual investors is to invest a sum called principal or capital in an investment that will be repaid to the investor plus a profit. That profit is called the return. Many investment options are available for individual investors. Some investments guarantee that the full amount invested will be repaid plus a profit. These investments include guaranteed investment certificates, GICs, and some bonds. Other investments do not guarantee that the amount invested will be repaid. These non-guaranteed investments include stocks, mutual funds, and real estate. Where do segregated funds and annuities stand in respect to such guarantees? This chapter and this manual describe how these insurance investments provide guarantees, to whom and when. Investment basics. Some investment basics are fundamental to understanding how investing works, how returns are generated for investors, and how investors manage risk. Compounding, compound interest. Compounding is a concept that is basic to investing. It is a very powerful investing tool. Compounding usually refers to earning interest on an investment. When the interest is paid, it is reinvested in the investment. The next interest payment is based on the principal and interest already received. As a result, the investor earns interest on interest. This form of interest is called compound interest, and it achieves escalated investment growth. Compounding is especially effective when it is applied over a long period of time, as the compounding effect accelerates. Time is money's best friend. That is why advisors recommend that individuals start saving as early in life as possible, so that the benefits of compounding can be realized to their full potential. In order for compounding to work to its maximum potential, all investment returns must be reinvested. Withdrawals diminish compounding. Unfortunately, compounding also has a negative side, since costs can also compound. Debt, in which an outstanding unpaid balance is charged interest, also compounds. Investment returns. All investments have one of three types of return. Returns can be positive and reflect a profit earned from the investment. Returns can be neutral, in which the investor receives the sum initially invested. Returns can also be negative. In this case, the investor will not receive back all the money invested. This is a risk of investing. The return is often expressed as a percentage of the amount invested. In those cases, it is called rate of return. It can be a positive number, such as 10%, or a negative number, such as minus 10%. In some cases, investors may be informed of the expected rate of return on an investment before they invest. In others, it is impossible to tell investors what to expect because the return is unknown. This is a characteristic of a risky investment. There is also a scale of risk expressed for investments, which is a guide to the investor about how likely it is that he will receive all his money back. The scale of risk plots the amount of risk an investor takes on in a range between the bottom of the scale, which is very low risk, and the top of the scale, which is extreme, called speculative risk. An investor with a very low-risk investment can be very confident that he will receive back all his invested money. Speculative investments are the most risky. It is highly unlikely that an investor with a speculative investment will get back any of his invested money. There is a very high degree of risk that he will experience a negative return and lose money. However, there's also a possibility of very high returns and earning a significant profit. Moderate or balanced risk investments are in between the two ends of the risk spectrum. Why would an investor consider risky investments? Risky investments provide the opportunity for far greater positive returns than those with lower risk. This concept underlies investment risk-return theory. It is based on rewarding those who are prepared to risk their money with a better return. Investors who are not willing to risk the loss of their money receive a lower rate of return. Returns are classified as nominal returns or real returns. A nominal return is the slated or advertised rate. For example, a savings account is advertised with a 2% return. That is its nominal return. Real return is calculated as the nominal return on an investment minus the rate of inflation. Asset classes. Asset classes are categories assigned to investments that have similar characteristics and are governed by similar laws and regulations. The three main asset classes are stocks, also called equities, bonds, also called fixed income or debt, and cash, also called money market instruments. Two other classes are often added. They are real estate and commodities. Each type of asset class has its own risk and return features. Asset classes are fundamental to the investment concept of diversification. Diversification. Diversification manages risk. It is based on the idea that by combining asset classes and investments within those classes, investing risk will be lower and the expected overall returns may be higher than if all savings were put into one investment. Another form of diversification uses foreign investments to take advantage of different economic conditions in other countries. Segregated funds are a good example of a diversified investment. Each segregated fund is invested in a wide range of investments specific to its type of segregated fund. For instance, a bond fund is diversified across a broad spectrum of bonds in its portfolio that mature at different times, have varying degrees of risk, and make payments at different interest rates. Other investments that offer similar diversification include mutual funds and exchange-traded funds, or ETFs. It is very difficult for an individual investor to achieve meaningful diversification unless he invests in a fund-type investment. Most investors simply do not have enough investment capital to be able to achieve adequate diversification on their own. Liquidity. Liquidity describes the ability to cash in or sell an investment quickly at or near its current market price. An investment that has characteristics of liquidity is called a liquid investment. A savings account is a liquid investment because some or all of its value can be quickly accessed for use. An investment that does not have characteristics of liquidity is called illiquid. Real estate is often cited as an example of an illiquid investment, since the sale of a property may take some time to complete and the sale price may be less than the market price. Liquidity is essential when a part or all of an investment will be used to provide an emergency fund to an investor. An emergency fund is a portion of earnings set aside for emergency purposes, such as when there is a sudden need for income due to an unexpected job loss. When such a need arises, the investor must be able to quickly and easily sell his investment and obtain its highest market value. The time value of money. The present value of money is one aspect of the principle known as the time value of money. The future value of money is the other. It is very important to understand the differences between the two. Both principles are based on the potential for invested money to increase in value over time. Present value. Understanding present value, or PV, and being able to calculate a present value sum is essential to many financial planning activities. Present value works backwards from a future date. It answers the question of how much is needed now to achieve a future savings goal. Therefore, it would be used to help a person determine how much needs to be saved today to yield a specified pension at a future date. Likewise, a parent who must meet future post-secondary education costs for a child could be provided with that information from a present value calculation. Present value tells us that if $5,000 is needed at a future date, then less than $5,000 needs to be saved today, because today's sum will earn interest and grow over time. The present value calculation is performed when the future sum is known. The future date is known when the sum is needed, and when the interest rate between today and the future date can be specified. Present value is generally calculated using a calculator through an online resource or with software provided by insurers. It applies to both the sum of money and cash flows. The formula for the calculation is present value equals the future value divided by 1 plus the interest rate to the power of n, which is the number of periods for the calculation. Future value. The future value, or FV calculation, provides the value of a current investment at a future date, given the interest earned on the investment. It answers the question of how much a sum invested today will be worth in the future. Therefore, a future retiree has a certain amount saved for retirement purposes. He can determine how much that amount will be worth at retirement with a future value calculation. The calculation is performed when today's amount of investment is known, the future date is known, and the interest rate between today and the future date can be specified. Like present value, future value is generally calculated using a calculator through an online resource or software provided by insurers. The formula for the calculation is future value equals the present value multiplied by 1 plus the interest rate to the power of n, which is the number of periods for the calculation.